Hello and welcome to Martin Lucas Investor. My name is Sensei and you're watching the Morning Forecast Show. Today we are looking at a bunch of data, specifically jobs data, unemployment data, spending data. Let me put it up on the screen so you can see exactly what we're looking at unfolding in about 45 minutes time. So I'll also put that timer on the screen for you as well. Let me put that over there. Just under 45 minutes time now. So average hourly earnings year over year, non-farm payrolls, retail sales month over month, retail sales control group, unemployment rate. These are the things we're looking at. All of this is being released at the same time in 44 minutes time. So we'll come on to that in a second. We'll give you all the analysis for that at the same time. Look at oil. Oil. Remember, double bottom, $55. Charts don't lie. And $55, we got the double bottom, the break of trend at $62, the secondary break of trend at $70, and we blew past the 77 resistance, looking at $92 now. Oil up 10% today. This is up more than on the first day of the war. So keeping an eye on oil because of course that affects inflation, recession, all those sorts of things. So if you have just tuned in, I do ask everyone to just take 1 second and hit that like button. It takes absolutely no effort at all. It's just a little button. Go and tap it right now. I know no one has done it yet. I'm sure there's a few. Let's check how many people have done it. Gonna refresh it. I'm gonna refresh it before anyone had the chance to hit the like button. And I
After
do
me
ask
telling
everyone to
you.
just take one. Let me see how many people. 19, and there's 160. I told you, literally no one has. I'm sure the 19 are the proper Lucasades. Come in every day and hit the like button first, guys. Just take 1 second and hit that like button. It is completely free. Clay Scott said, just read through the news Sensei newsletter, ready to roll. Clay Scott, lovely that you've done that. Everyone should make that a very easy habit. I mean, look, this newsletter just came out, has everything about the jobs data. You can go to sensei.news, check your email, check your app, whatever you rather, you can go and find the newsletter there every single day. The first thing that pops up, the top stories at a glance. You can be ready for the day. See what the top stories are just as you wake up, 2 hours before the opening bell. That's when you need to know the news. US submarine, Gulf investment pledge faces cracks, Trump signals Cuba regime change, Asian markets hit 6-year low, Washington grants Indian oil waiver, February jobs report preview. You've got the one big thing straight away. You know what the big story is. You know what the number is. You know what the winners and losers are in case you do hold any of those stocks or you want to see what the big winners and losers are in the market today. What's going on in the market with your market snapshot? The 5 things you need to know. I have changed the process, so I actually spend more time writing these stories now. So go check out if you've stopped reading the news, get back into the habit of doing it. You've got the 5 stories there in more detail. You can skip to your favorite stories, or at least read 3 or 4 of the stories every day. You will get much more knowledgeable. And then go over to deep dive because today is February jobs report cheat sheet, Friday, 6th of March, releasing at 8:30 Eastern Time, 1:30 GMT, and there's a lot coming out, and this cheat sheet breaks it down for you. We don't go through all of it in our live shows. I do try and bring you as much information I can, but again, having those tables in front of you, knowing what's being released, at what time it's being released, if it's in line, if it's above, then moving on to the next data piece. It's much easier having that newsletter in front of you and following along with the show. Anyway, we'll come on to that in just a second. We are also looking at rate cuts, but also potentially rate hikes. We do have the charts on the screen as well. S&P 500 just falling down a little bit now, and so is Bitcoin. If we go over to the main charts today, and let's remove that one, we're looking at oil now up nearly 10% on the day, 9.7%. Silver up 0.3%. Bonds up nearly 1% today. This is turning into, I mean, if these jobs reports aren't as what the market wants to see, we can turn into a very red day, or we can try and turn around what the market is experiencing right now, which is the S&P 500 down again 0.5%. It's struggling to hold up. It's struggling to get these rallies. And how long have we struggled to break all-time highs? A very long time on the S&P 500. And again, if the S&P 500 is coming down, the broader market's coming down as well. XRP is now down. It tried to rally above 138. It's failed, and let's see if it holds 138. If it does and the report is good, then we can try and bounce off these levels. We are above support. But if they are bad, we can fall straight below 138, confirm that as resistance, and start heading back down to our lower targets. Ethereum down 1.28%. The Nasdaq down nearly 1%, and Bitcoin down 1.5% after it broke its downwards trend and hit to the very T our resistance at 74,000. Let's see if it can hold outside this trend line and have another attempt at 74,000. We will see the direction of the market in about 38 minutes time when we get all of those releases in the numbers. Again, if I can ask anyone who's just tuned in to hit that like button, that would be absolutely incredible. If you haven't got the newsletter yet and you want all of that information, the link is in the live chat. You can get a free trial using that. I think is this another link over here? No, that one won't work. So let me delete that one. Let me delete that one. Yeah. Okay. So I think I've removed that. Remove. There we go. Okay, so let's get into the stories. We do have Bloomberg running as well.
Well, first of all, it's important to say that it's not actually so much the disruption of supply that creates problems, because first of all, we don't get any oil or gas from Iran directly, and we get some limited amounts of gas from the Gulf region overall. But that's not, it's not nothing, but it's not the big problem. The big problem is the effects on the global markets. And of course, those effects on the global markets also hits consumers in Europe, especially on oil and on LNG.
So, Commissioner, do you see a reason to try to step in and stave off some of the increases in price, or do you think that this will right-size itself because ultimately the EU isn't as dependent on Iran and sort of some of the regional supplies?
So I saw earlier that you compared this crisis to the crisis in 22 when Russia started its full-scale invasion in Ukraine, and I understand why, because this is the worst crisis we've had since. But it's also important to say that we are not close to the level of crisis that we have in 22. The prices are higher, yes, but not close to as high as they were there. So that's number one. Number two, we are also much better situated to dealing with these price increases. We have a more diverse.
This is the big issue right now. Oil, gas prices going through the roof, and we're looking at potentially inflation continuing that trend. So let's tune into Bloomberg for just a couple more minutes, and then we'll come into the full data release of today.
The import from Russia for obvious reasons. So this diversification puts us in a better place. Also, we've reduced our consumption of gas, and we're deploying more renewables every year. This means that we get cheaper energy. It means that we get homegrown energy. And it, of course, also means that we are in better control of our own destiny in these areas than we were before. But we are still exposed to the global markets, so we don't take it lightly.
Commissioner, have you had any conversations with Chris Wright over in the United States about potentially increasing liquefied natural gas exports to Europe in order to stave off any output from Qatar that is interrupted?
Yes, we have a continuous dialogue across the Atlantic, both with the American administration, but also, of course, with the companies and with.
Okay, we're looking at Europe and gas prices and oil prices there. Now we're going to come on to our main story of today, which is all about the jobs report that's coming out today, plus a few other bits and bobs coming out at the same time as well. So let's get into it and get ready for it. We do now have 72 likes on the show. There is 200 people watching, so I know a lot of people still haven't hit the like button. Please do go ahead and do that. Let me know if you're here in the chat. I would love to see everyone's names rolling through. I have seen many names come through: Potato Family, Yolanda, Ricardo, Dan Ackerman, Jacko is here. Jacko from Player de Carmen, I absolutely love it. Jacko supported us big on the weekend. Rhino Skin is here. Human Being Liz is here. Just reading through the newsletter. Thank you, Clay Scott. Ready to roll. That's the point of the newsletter. You read it and you're ready to go. Sensei, you should try reverse psychology. Okay, don't hit the like button. Do not hit the like button, guys. Hello, why is oil up? Why is oil up? Well, because of the situation in the Middle East and also a technical break. and it's lasting longer than some are worried it's lasting longer than it should. Afternoon, everyone. Blood Eclipse says, honestly, as much as it would hurt my portfolio, I hope for no rate cuts. It might put the market in a bigger buy range for me, says Blood Eclipse. Yeah, I mean, look, the thing about investing is if you're not planning to retire in the next 15, 20 years, 10 years, 5 years, whatever it is, you just want it to go down, really. You want the prices to be as low as possible for as long as possible until you start reaching retirement age. Or when you want to retire. Slim Jim is here. Jack is here. Yolanda's here. Let's get to at least 100 likes. Exactly. How about silver? It took a dive this week. Will it head up soon? I do believe so. I think $100 is in store for silver. Again, it's going to be volatile. We're in the final stage of the precious metals run. Gold will go to all-time highs, in my opinion. Silver will go to potentially $100, maybe $120 and roll over. I don't think we're going to get a massive surge from silver anymore. Remember, but yeah, I think it's going to be volatile because it's the final part of the cycle for precious metals. But I do think we will head higher before we ultimately go into a bear market. Zach Zate is here. Happy Friday. Lovely to have Zach Zate here. Subwoof is here. Human Being Gliz is here. Yeah, everyone, please get involved in the chat. I'd love to see everyone's names rolling through while we start our coverage of the data release. So let's get straight into that coverage. Two simultaneous releases hit at 8:30 a.m. Eastern Time today, covering 4 key data points. Let me see if we can move this up slightly. There we go. February non-farm payrolls, the unemployment rate, average hourly earnings, and January retail sales. That's all the stuff we're getting in 32 minutes time. Together, they provide the most complete read yet on whether the US economy is slowing down or stabilizing. And they also land 12 days before the Fed's next rate decision. So 12 days time, we're going to see if the Federal Reserve at their FOMC, which we'll be covering live on the show, are they going to raise rates, cut rates, or keep them in line? Well, I'm 99.9% sure whatever this data release is today, they're going to keep rates where they are. But that's not the point of covering this data release. It's not about the FOMC in 12 days' time. Yes, what they say today might affect what Jerome Powell says, which is the important part. It's not going to affect whether they cut or not, because that's very much baked in. We're not having a cut or a hike. The data today is important because it will affect what Jerome Powell says in a statement. It will affect what the members of the committee will say in the FOMC minutes, and it will affect future rate odds. The market's always forward-looking, and we're pretty much baked in what the decision will be in 12 days' time. That doesn't mean this data report isn't important. It's all the other things that are actually more important than the cut or raise or hold itself. Together, they provide the most complete read yet whether the US economy is slowing or stabilizing, and it lands 12 days before the Fed's next rate decision. Against a backdrop of, remember, don't forget about what's actually happening behind the scenes. This is not happening in a vacuum. There's a backdrop of surging oil prices. There's escalating tariff uncertainty, and a Fed that just hinted for the first time in this cycle. We covered this to the minute before Bloomberg even covered this when we did the FOMC minutes, because the Fed a couple of weeks ago hinted for the first time this cycle that rate hikes are back on the table. And that was before oil prices started going up. So let's set the scene very quickly. The Fed cut 3 times in late 2025 and has been on hold since. As the January meeting, the vote to hold was unanimous, but the minutes released on the 18th of February contained a notable shift. Several participants indicated they would have preferred two-side language in the post-meeting statement, explicitly acknowledging that rate hikes could be appropriate if inflation stays sticky. And this was in the minutes. So they said, we got to see a behind the scenes of the meeting, and there was several people that said, we need to start thinking of potential rate hikes. Not saying that we're going to do rate hikes, but for the first time ever, they've said we need to look at rate hikes, and that could be something that we use this year. Again, it's nobody's base case that they will move to a rate hike, but the language is now in the public record. That matters today. A strong jobs numbers, remember, mainly jobs data we're getting today. A strong jobs number or hot wage print no longer just delays cuts, it brings in hike talks back to conversation, because if the jobs market is very strong, if there's no risk of unemployment spiraling towards the upside, which the Federal Reserve has said that risk has diminished and diminished and diminished, and it's actually no longer likely. If this data backs up that the jobs market is very strong, or if we get wage growth very high, which could lead to inflation, and the jobs growth is very high, then forget about delaying rate cuts. Now we can start talking about potential rate hikes to control inflation, because the jobs market is no longer an issue. The macro backdrop is complicated. Operation Epic Fury, the US and Israeli airstrikes on Iran, began 28th of February, has pushed Brent crude towards $89 a barrel, and we're spiking as we speak right now on oil. We just went literally moments ago, to $87. We're up nearly 10% on the day. You can see the big increase over the day. People thought that that first surge was it on the day the war broke out and the day that the markets opened, but they were incorrect. We've gone a lot higher since. Its biggest weekly gain since 2022, that's for oil. Energy-driven inflation is exactly the kind of price pressure that makes the Fed reluctant to cut even when growth is slowing. So we've seen growth slow in the economy, but they might not cut because they might be looking forward and saying, actually, if this war goes on for a while, then it will be silly for us to cut when there's no need. Jobs data is great. Inflation data is bad. It could get worse. There's tariff uncertainty. Why would we cut? That's what the Fed will be thinking. On top of that, Treasury Secretary Bessent said this week that the tariff agenda was on the verge of changing again, creating policy uncertainty that has been suppressing business investment and hurrying throughout the year. Look, there is another on the other hand of all of this. I am talking about, let's say, jobs are strong in this. We don't know what the data is. That's coming out in 27 minutes. But that's the scenario that will move the market more. If jobs data is very strong, if personal spending is high and unemployment is low, that's the scenario where the market does continue its downtrend. We're in a bear market. We're looking for reasons this bear market will continue. However, let's say jobs data is a real concern. Unemployment has skyrocketed. Spending is decelerated, and jobs aren't being created, and there's a bit of concern. Then yes, at that point, we can be looking at more likely to have rate cuts. But again, it's just one piece of data today, and you need to put it into the bigger picture. The bigger picture right now, the picture. Every time we have these data releases, it's like someone putting a bit of paint on a picture they're painting, and that picture is very much forming right now that it's a downtrend, no need for rate cuts, rate hikes. And if we continue painting that picture, then we continue with the trend. If today we come out with some strong reasons for rate cuts, then that whole picture is not going to change just because of one data release. But if we come out with data to support rate cuts, then that picture continues to form, and the market will more likely react to it and start forming that bear market potentially. Anyway, let's continue, because we could get a pump in the market again. There's one thing about short-term volatility in the market. We could get a pump today if all the data is in favor of rate cuts, but the later trend could continue down. So again, it depends. Are you short-term trading? Are you trading this event? Are you trading over the day, the week, or are you looking over the month, 2 months, 3 months, and the rest of this year? I personally do a bit of both, but mainly swing trading and long-term investing for the rest of this year. So the picture that's being painted in my mind with all the information I'm gathering is a year of opportunity, a year of volatility, a year that we continue to potentially head down, a year of building those positions, not a massive bull market year, in my opinion. Whether that's for crypto or the stock market, my consensus is the same for both. If we're looking at the decisions for hold or cut within the meetings, for March, 97% chance of a hold. For April, 89% chance of a hold. And for June, 66% chance of a hold. Now that's June is the meeting. We want to see if there's any change. The data released today can affect June. It won't really affect March. It might affect April to a small degree, but June is the month where we can move from hold to cut pretty easily based off data. So if the data supports rate cuts, it's not going to change our March meeting 2 weeks time. It will probably change the June meeting. Non-farm payrolls is the first one of the bits of data that's coming out, potentially the most important bit of data coming out today. So what is it? The Bureau of Labor Statistics surveys approximately 121,000 employers monthly to count every job created or lost across the US economy, excluding farm workers, household staff, and non-profits. The survey captures the pay period containing the 12th of the month. February survey window was 10th to the 16th of February. So where has it been historically, or where have we been? The headline looked healthier than reality. Annual benchmark revisions published in February showed a total 2025 job creation was revised down from 584,000 to just 181,000. So these have been revised down quite heavily, roughly 15,000 per month. So the numbers we got were 584,000, and they got reduced to 181,000 in 2025. The previously reported figure implied 49,000 per month. Almost all growth came from healthcare and social assistance. Strip that out, and the 2025 numbers would have been deeply negative. Federal government shed roughly 300,000 workers across 2025 as Doge layoffs began. January 2026 came in at positive 130,000, a beat versus the 70,000 consensus. But JP Morgan believes it's overstating underlying momentum. The key distortion, what we're going to get this month, approximately 31,000 healthcare workers at the Casa Permanente in California and Hawaii were on strike during the BLS survey week. Under BLS methodology, Bureau of Labor Statistics methodology, striking workers are not counted as employed. The strike ended on the 23rd of February after the survey week, meaning those 31,000 workers will be absent from Friday's count and will reappear in additions in March. So be careful if you're getting confused. There is going to be a key distortion in this data, but again, that's baked into the consensus and just might not seem right in the numbers. And we might see an increase, but that's, again, we'll always compare it against what the market's priced in, which takes into consideration all of this. Bank of America revised its February forecast down to 35,000 specifically because of this. So the consensus across the board is about 59,000 for non-farm payrolls. That's the number we're looking at. The more it deviates the upside, the more it deviates the downside, the more it deviates away from that number of 59,000 for non-farm payrolls, which we'll be looking at by looking at Bloomberg and also looking at, it normally comes here a little bit quicker. So when we see this non-farm payrolls highlighted just over here, where it says 59,000. Oh, God, it's hard to do it. Over here, right here, 59,000. We're going to get the actual number over here. The further away we move from 59,000, for example, if we're at 10,000 or if we're at 130,000, further away we move from 59,000, the bigger the move the market will have because we're deviating further away from what the market has priced in. If you guys are with me and understanding everything I'm saying so far, put a 1 in the chat. So I want to see everyone hit 1 if you understand, if you're with me, if you're following along, if I'm explaining it okay and you're understanding what I'm saying. Put a 1 in the chat, or if you don't have a clue what I'm talking about, put a 2 in the chat. Let me know in the chat. Yeah, 1 or 2. Also, if you have just tuned in, we're 20 minutes away from getting all this data ahead of the FOMC. Please do hit the like button, subscribe if you haven't done so already. If you want to follow along with our deep dive or get these cheat sheets for all these events we do, it is pinned to the top. Dan says 1. Let's see. Okay. Dan Ackerman, Dan S says 1, Yolanda says 1, Dan says Ganda Salam says 2. Let me know what you're confused about. Great job with the newsletter. Oh, thank you, Eric. No worries. Everyone's with me. Okay, we'll continue. Everyone's with me. If you're not with me, who said that? It was Ganda. Follow along with the newsletter. Break it down. Go slower. Use the newsletter. Throw it into an AI software and say, help me understand this newsletter. Answer my questions, and it's great. At least you've got the real news in front of you, and then you can talk to someone about it. Human being says, because of my English. Brilliant, brilliant. Great job with it. Okay, yeah, everyone's following it along. Okay, non-farm payrolls, consensus 59,000. The more we deviate, the more the market impact. And again, we've got this table in our newsletters which says, let's say it's above 100,000. That is a hot non-farm payrolls. Equities will be mixed to negative. Good news is would be fewer cuts equals growth growth stock sell. So more jobs created, the dollar will strengthen, gold will sell off, and rates March will hold, and June cuts odds shrink. So if we have more jobs being created, mixed reaction on the market or negative reaction, probably a more negative reaction because more jobs are being created, and therefore rate cuts are not going to be expected. So if you see non-farm payrolls above 100,000, again, there's a lot of data being released, so you can't take any of these bits of data in a vacuum. You have to quickly move on to the next one and see what the next one's saying. But essentially, if more jobs are being created than expected, rate cut odds decrease. If it's in line, limited reaction, we move on to the next data point. If it's cold, if it's below 25,000 or negative, that's when the initial pop will fade, recession fears potentially will come out, but then rate cut odds will jump to 60% plus, and we might even get emergency rate cuts if we get literally negative jobs being added. Then we look over at the unemployment rate, same sort of story. So the unemployment rate comes from a completely separate survey to non-farm payroll. So different bit of data. While payrolls counts jobs from employer records, the unemployment rate is drawn from a household survey from 60,000 homes. It measures the share of people actively looking for work but unable to find it. The two can move in opposite directions in the same month. So where has it been? The rate has drifted up from a cycle low of 3.4% in early 2023 to about 4.3% today. The broader underemployment rate, which includes part-time workers who want full-time work, sits around 8%, with 4.9 million people in that position, the highest since the pandemic. The deterioration in employment quality does not show up in the headline number. So the consensus for this, the unemployment rate is 4.3%. Again, an important technical flag. This release includes annual revisions to the household survey, incorporating updated Census Bureau immigration data, because immigration has sharply collated under the Trump administration. Revised population estimates will be lower, potentially shifting the unemployment and participation rates for purely statistical reasons unrelated to the actual labor market conditions. Treat any unusual movement in these two figures with context and with that context in mind. So if you see a bit of a discrepancy between the unemployment data and the non-farm payroll, there is a little bit of a discrepancy. If you want to understand it a bit more, go and read that again. So again, what I'm going to be looking at, the consensus is 4.3. If it's higher, unemployment's higher, rate cut odds increase. We can get a rally. If it's better than expect, again, this does get complicated the more you look at it, because if we do have really high unemployment, then we've got recession fears. But if we've only got employment a little bit higher and we get rate cuts, that's liquidity in the market. So everything to a degree. So again, if we get, I don't know, 5%, 6% unemployment, you might go, wow, we're going to get rate cuts. Yes, we're going to get rate cuts and probably emergency rate cuts. But actually, the market's going to be so worried about recession, the market's going to drop. So you have to take everything in context. It's not as easy as above this, we rally, below this, we rally. It is to an extent, but if it is like 5% unemployment today, then the market's not going to be rallying. It's going to be very scared of recession. But yeah, most likely, if we do get a deviation that's to the upside, it might be 4.4, it might be 4.5, more 4.6, which would just indicate a rally. Yes, people might talk about recession a bit more, but the rate cut odds increase and we get a rally because liquidity will get injected in the market. If we're at consensus, then we look at the other data points. If it's below what's expected, if we get unemployment lower at 4.1%, 3.9%, 4%, then the Fed will look at the employment market and say, they'll look at the labor market and say, actually, there is no issue with the labor market. There's a big issue with the inflation market. So we're not going to cut rates because the jobs market's fine and the inflation market isn't. Then we're going to get average hourly earnings. So this is all happening in about 15 minutes time. I'm going to reiterate everything at the end as well. So what is average hourly earnings? Human Being List says almost 400 watching. Please hit the like button. Yes, please do hit the like button if you have just tuned in. I know a lot of people have just woken up. They're a bit bored. They're a bit groggy and grumpy. It's free. Hit the like button. Subscribe. Grab the newsletter so you can follow along on this data release. There is a free trial there. There is a free plan. You don't just get that. You get tons of things in the newsletter. Lots of resources. We just released our net worth tracker app yesterday. Go check it out. Average hourly earnings. What is it? Average hourly earnings measures how fast wages are growing across the economy. Very important. It matters to the Fed because rising wages feeds directly into services inflation, which has been the most stubborn part of the current inflation problem. The Fed considers roughly 3 to 3.5% annual wage growth consistent with its 2% inflation target. So remember, wages going up causes inflation, and it causes inflation in the services side. And that services side of inflation is what's been keeping inflation pretty high. So the Fed says if wage growth is between 3 and 3.5%, that's fine, that's healthy, and that will be consistent with our 2% inflation target. But here we go. What are we actually going to get? So where has it been lately? Wage growth has been a bit higher than what the Fed want, between 3 and 3.5. It's been at 3.7 year over year, above the Fed's comfort threshold. Last month's reading came in at 0.4% month over month, which annualizes to nearly 5%. So consensus is 3.7% year over year and 0.3% month over month. So this is average hourly earnings. You can see it's at the top of the list here. The two over there. We'll get the month on month, we'll get the year on year, and you can see it's highlighted in red. This is high impact. It will move the markets. So the consensus for month on month is 0.3. The consensus is 3.7. Consensus means the market's priced that in. That's what the market's expecting. The further away we are from those numbers, the more the market will move. So going back to it, consensus for year over year is 3.7, 0.3 month over month. So let's just hone in on those yearly numbers. And you can apply the same to the monthly numbers. Above consensus, if we're 4.4% plus year over year, that means wages are re-accelerating. Hike talks return. Fed has no reason to cut anytime soon. They won't be cutting because they would say this is going to feed into inflation, and we'll just be shooting ourselves in the foot. We're going to cut so that we can raise rates next month. It doesn't make any sense. So they'll rather keep rates where they are and potentially raise rates. So if we get a high reading on average hourly earnings, higher than expected, the market won't like that. So the dollar might go up, but the equities will be down, crypto will be down. Rate cuts will be pushed later, and potentially rate hike talks will come. If we're at consensus, then again, you look at whatever other data is moving more. If we're below consensus, below 3.4% or lower, then that means wages are cooling. That opens the door for earlier rate cuts. The expectations for rate cuts in June will come in the favor of actual rate cuts, and we can see rate cuts this year, and the rate hike talk might start fading a little bit. And then we'll get the equities rallying. So if we get average hourly earnings lower than consensus, that's when you can see a rally on the market. And number 4, and finally, again, we'll reiterate all of this just before the data comes out. We've got Bloomberg ready to go. If you are watching live with me, make sure, let me move that for a second. Make sure when you're watching me, you've got this live button. It's red, because if you're not live, it will show something like this. It's a gray button. This is a tip. Whenever you're watching us live and there's data releases, I want you guys to be up to date with me. So press that button that says live. And there is one extra thing you can do, mainly if you're not on a desktop, or you can try it on anything, but mainly on a desktop. You see this cog button? You can press that cog button. And what that does is once you press playback speed, you can actually even be more live. It's a little hack within YouTube if you want to be even closer to when I'm talking, because there is right now, if you press the live red button, you're probably 20 seconds behind me. But if you come over here and you press your thing at 2x or whatever, you can playback speed even. So firstly, make sure your red live button and then go into the cogs and press 2x, and essentially it speeds it up. I've just done that with Bloomberg, so I'm about 5 seconds behind now, or 3 seconds behind Bloomberg. You're going to be about 2 seconds behind me, so you'll be 5 seconds behind the data release if you've done both those steps. So I recommend everyone does that, and again, closer to data release time, do that again, because slowly over time you'll just be fading 1 second back, 1 second back. It's just the way YouTube works and captions work. So that's a top tip there for you. We'll go over to Bloomberg.
What the markets are.
We'll get their analysis. Then I'll give you my analysis. We'll have the markets on the screen. So on the left, we have the S&P 500. On the right, we have Bitcoin. We'll go through all the rest of the markets on this screen as well, with the with oil, gold, the Nasdaq, all of that. And at the same time, we will be looking at the data and what it means. And over here is probably where we'll get the data first, which will be here on the economic calendar. So I'll give you a very quick, if there's any breaking stories from that, I'll tell you straight away. Then Bloomberg will be a little bit later than when we get our data. We always get it before Bloomberg. So that's what's going to happen in about 9 minutes time. So get ready for that. Let's continue with our last major data release and what it means for the markets, which is retail sales. And that will be the January numbers. So what is retail sales? Morning, I have a question. Is it going up a little bit tonight or go low? Egg, that is a question that just means nothing, to be honest. We're investors here. We're traders. We're swing traders. No one knows. It's not about I'm going to make a prediction. We're going to go up today. We're going to go down today. That's just ridiculous. And if you think you can make those predictions every day, then you should be a billionaire in a month. That's not how it works. That's not how the market works. It's not a get rich quick scheme. You need to be prepared for every scenario. You need to control your emotions. You need to have your long-term thesis in play, your swing trades in play. You need, again, I never give financial advice, and that's why I don't say the market's going to go up today or tomorrow, because I don't know. And if anyone tells you they know, they are being ridiculous. What you need to do is be prepared for all those scenarios. So this is what happened. This is what will cause the markets to go down. This will change my long-term thesis. So the more you start educating yourself, the more you start looking at these data releases, once you get the data, then you can react. But again, I'm not telling you see the data and react emotionally. It's see the data. Is there a trade to be made? If there is, and sometimes there is, we're completely out of line and there is a trade to be taken. Or you just add to your long-term knowledge bank of what's going on in the markets so that you can build your thesis so you can apply to all your trades. It's not about, I know that once this data comes out, we're going to be up. Or I know that later today we're going to be up. No one knows that. And if you trade like that, you're just, it's just ridiculous. So we refrain from asking questions like, are we going to be up today or down today? Or is this going to be bullish or bearish? We don't know. We will know once the data comes out. And then we can apply our knowledge to it. So let's get prepared for it. Retail sales, the last bit of data. I'll revise everything else we've just gone through in a second. So what is retail sales? The Census Bureau measures the total value of goods sold at retail businesses across the US, from car dealers to online retailers. This is an advanced estimate, nominal, not inflation adjusted, based on surveys of roughly 5,500 businesses. Consumer spending is approximately 70% of US GDP, making retail sales one of its most direct reads on economic momentum. The most important subline is the control group, which excludes autos, building materials, and gas stations. Let me put the markets back on the screen for reference. On the left, you've got the S&P 500. On the right, you've got Bitcoin. So where has it been before? December 2025 came in at a flat 0%, following the prior month of a negative 0.3%. The control group has been negative. Weakest has been attributed to post-holiday pullback and winter storms. One potential offset is Wells Fargo's estimate of $517 billion in total IRS tax refunds in 2026, that's largest since 2017, with many households receiving 500 to 1,000 larger refunds than prior years. Early refund processing may have provided some consumer support in January. So again, with this one, the consensus is negative 0.3. The consensus is what the market's priced in. You can see it's this one over here, right above my head, 0.3. This is retail sales month over month. Consensus is negative 0.3. So if it's hot, if it's above 0.0, that's consumer resilience, tax refund tailwind is real, Q1 GDP tracking improves. So the reaction will be rate cut odds pushed further out. Equities will be mixed. So if we get hot reading, rate cuts, odds decrease and they get pushed further out. If we get a cold reading, so if it's below negative 0.5%, it means second consecutive meaningful decline. No refund bounce is visible. Consumers pulling back. Bonds will rally. Gold will hold. Dollar falls. Equities also sell off on GDP downgrade risk, but also potentially rally on rate cut expectations. Again, this one is one I'm not going to be looking at as much because it's harder to read which way it goes. It depends on the other three releases. So if anyone is just tuned in, we're 5 minutes away from jobs data, unemployment data, and average hourly earnings. So let me just recap everything we've been through. Again, there's some subcomponents to watch. Again, this is in the deep dive. I normally recommend people read this in their own time as well and follow along. Average weekly hourly earnings, healthcare payrolls, retail sales control group, and then you have to put it all together: jobs, wages, and retail. And then you get your read on the economy. What could be a surprise? The January revision. Again, we talked about that in the non-farm payrolls. The participation rate collapse. And again, what comes next? We're looking at US CPI next week, US PPI next week, the FOMC meeting in a couple weeks' time, and then the March report. The way I'll be looking at this is, number one, I would look at the non-farm payroll headline. We would adjust for Cassia because that's already in our numbers. And then I'll look at the private payrolls, the average hourly earnings, and then the retail sales control group. Be careful of the first move. The first move is not always the correct move. And again, this is not financial advice. I don't recommend anyone trades this. I just do this for knowledge, to increase my knowledge. Sometimes I trade these events. Most of the time, I don't. It just sets the scene for my investment. So we're going into this with a 3 FOMC meetings forecasted of no rate cuts. So we're seeing, is this data going to support rate cuts or not? Number one, we're getting non-farm payrolls, which is obviously jobs data. The consensus for non-farm payroll would be 59,000. The more it deviates from that, the larger the move will be from the market. If it's above 100,000, more jobs are being created. So that would mean rate cut expectations go down and the markets will sell off. And that's the first number I'm looking at. Is it hot or not? So that would be, where would that one be? Non-farm, non-farm, non-farm. It's this one here. If I see that one higher, I'll be initially bearish. Then we'll move on to our next one, which is unemployment rate. If that's also lower than expected, so unemployment rate over here, down here, you won't see it, it's over here. That's at 4.3% consensus. If that's lower, if it's at 4.2, 4.1, as the Fed is forecasting, employment is not an issue. They won't need to cut rates. So again, that's another bearish factor. The next one will be average hourly earnings. If it's above consensus, that means that's going to feed into inflation. So that's, which one's that? Average hourly earnings. That's projected at 3.7%. If that's higher, and to what degree higher, then that could be bearish on the markets because that'll feed into inflation as well. On the contrary, if we look at all these numbers, let's go from the top to the bottom. Average hourly earnings, consensus 0.3%. The higher it is, the more likely inflation is going to continue. So therefore, rates will be held where they are. There won't be rate cuts. If we get that lower, if we get average hourly earnings lower than consensus, then we'll get rally. Again, that's if it's in a vacuum. You have to look at all of them. But we'll get rally because inflation is not going to come out of average hourly earnings, which is good for rate cut expectations. Non-farm payrolls. Amount of jobs, the more the jobs, the less the reason for the Fed to cut rates. So if we consensus at 59,000, just above my head there, it's highlighted in grey. 59,000 is the consensus. If it's at 100,000, the market will come down. If it's at 20,000, the market will rise because less jobs being created equals more chance of rate cuts. Retail sales there as well. Again, not too much you can take away from retail sales. We will have a look at it. But then again, the other one over here, unemployment rate, just above my head, 4.3%. If unemployment rate is high, then what we will get is increasing chance of rate cuts and a rally in the market. If it's low, then we will actually have rate hikes on the table and a sell-off in the market. And we are going into this market where the S&P 500 is down currently 0.36%. We are going into this with oil prices up 10% on the day. If oil prices are up 10% on the day, that's going to affect inflation. The Fed is not really going to be likely to cut rates. So we're going into this with a bearish tune this year again. I'm positioning my portfolio. I've started the £5,000 portfolio challenge. Defensive, but AI growth, because AI is going to change the world, but I want to be positioned defensive with my certain stock choices and ETF choices, plus my gold and silver, which has been performing great. Well, that's part of my position. And then cash and bonds so that I can buy the market dips this year. So if you want to see what I'm doing with my portfolio, you can join the portfolio challenge. If you want the event sheets like you've just saw, you can join the newsletter. If you want the daily newsletter to get you ready for the day, 2 hours before the earning bell, you can join the newsletter. If you want the no BS chart analysis course, if you want the app we just released, all these benefits, join the newsletter. I'll give you the link in the live chat. There is a free plan, but there's also a free trial on that link. There is a monthly plan as well. So go check that out. But now we're 20 seconds away. So we're going into this with the market down, gold down slightly, oil up, and let's get ready for all those data releases coming out any second now. So we'll go over here, it will refresh, and then we'll go over to Bloomberg. Here we go. Breaking news. So we've got average hourly earnings slightly higher, so that's a little bit bearish. We've got non-farm payrolls down the toilet. down the toilet. Non-farm payrolls, negative 92,000. That is jobs being lost there. What else do we have? We've got retail sales and unemployment gone through the roof. Let's go straight to Bloomberg on that.
Last month's 130,000 revised down to 126,000. Not a major revision down, but a loss of 92,000 jobs. Now, there is certainly going to be some weather involved in that, and we'll check on that in just a second. The total payroll revision over 2 months is minus 69,000. So you got to add those two things together. Change in private payrolls down 86,000. Manufacturing payrolls down 12,000. Average hourly earnings up 0.4%, puts the year over year at 3.8%. That's a tick higher than it was. Average weekly hours 34.3, and the Labor Department says we'd see a decline in that probably if there was a weather effect. So it isn't clear that that is the case yet. And labor force participation drops to 62%. So some bad news on the labor front. Now on the retail sales front, and these are January numbers delayed by the government shutdown. Retail sales headlines dropped by 0.2, but ex-autos, they are flat. Weather may be an impact there. Control group up 0.3% after a flat reading in December. So a bit of an improvement, but not a huge jump in retail sales. So the numbers aren't particularly overall good this morning. I'll look at the further details for you and get back to you in just
Be careful of the first move. The first move doesn't always have to be right. I will analyze this a bit further. We'll go back to Bloomberg and then we'll come back.
Moment decline
in just a minute.
Mike McKee, thank you, buddy. Looking forward to those details. Right now, the headline: bad news is bad news. Equity futures near session lows. We're down across the board on the S&P 500 at the moment, declining by 0.8%. Underperformance from the Russell, as you might expect. We're down by more than 1%. In the bond market, yields flip from being positive to negative. We're down at the front end of the curve by 3 or 4 basis points on a 2-year at 354. This is double bad because I'll tell you a market that isn't moving in response to this, and it's the commodity market. Brent and WTI still near session highs. Brent close to 89, WTI close to 86, and this is the problem for the Federal Reserve. This is what you don't want. You don't want to see downside surprises on the economic data and then see upside surprises when it comes to inflation. That is not what you want to see at all.
This is the worst case scenario of, and I'm dreading to saying this, but stagflationary shocks. Essentially, oil prices rising rapidly at a time where there doesn't seem to be that much strength in the underlying employment market. The good news is that January wasn't revised significantly lower, only 126,000 versus the 130,000 previously stated. The bad news is it's not just that there was a job destruction in the month of February, but that the unemployment rate rose to 4.4%, raising questions about how you can look through this if you're trying to come up with policy.
Does it go against the grain? Let's think about the data we've had so far. ISM has been pretty good now for a couple of months, both services and manufacturing. The data we've seen elsewhere.
Let me just explain this to you guys. So what we've got is a massive shock, and the market doesn't like shocks. The market doesn't like uncertainty. And we'll come back for their analysis in a second. What we've just got is non-farm payrolls. No one expected it to be that low. It was negative 92,000. So you'd think, okay, jobs, there's less jobs rate cut expectation. Yes, but it's actually not that brilliant because what we've got is unemployment now heading back up, but inflation being an issue. So we don't really want massive unemployment surprises because inflation is now a problem, especially with the oil market. So if we're now seeing cracks in the labor market, but also seeing inflation becoming sticky, then what does the Fed do? They'll be stuck in a sticky position. That's why the market reacted like that, because this was a very a big shock to the market that they weren't pricing in a massive decrease in jobs being created, and an increase in average hourly, which is causing inflation, plus the oil market. So we'll come back to that. If anyone wants to get these cheat sheets, if you want to see access to my portfolio, if you want to see, message me one-on-one, DM access, the weekly crypto report, the daily news 2 hours before the opening bell, no ads, no corporate sponsors, the chart training course, the £5,000 portfolio challenge, plus the app we just released with the net worth tracker. You can get it for free. There is a free plan on the newsletter. There is a free trial as well. Go and check out the free trial. The link is right there. Let's go back to Bloomberg for more analysis on that, and then we'll come on to oil. Here we go.
Insurance, however, it's all like
the grain. What do the details tell you this morning?
Well, right now, it doesn't look like some of the outside influences we might have thought of had an influence. Only 228,000 people not at work because of weather. However, there is an impact on the strike side. There was a strike at Kaiser Health Insurance, 31,000 workers off the job, and we see a decline in health and social assistance of 34,000 during the month. So there is a significant issue there. We also see that average weekly hours did not move. So along with the weather, that's the basic issue that we have. Construction jobs down 11,000. That might have been weather. We were expecting a rise. We saw a rise in ADP. There's been a rise in the last couple of months because of the AI constructions. Private service producing jobs overall, led by these healthcare numbers, down 61,000. Financial activity is one of the few that gained 10,000. And government down
Guys,
by
please hit the like button if
6,000.
you're here.
So it looks like some of the Doge firings have worked their way through the system right now. Still looking at some more of this data, and I'll get you some retail sales data in just a second.
We'll come back to you, Mike. Thanks for that, buddy. Appreciate it. So this from Neil Dutta of Runmac. For him, this is why 2026 is not 2022. There was an energy shock in 22. We had a strong job market, excess savings to draw down today. The labour market sucks, and saving buffers have been drawn down. Neil's opinion this morning.
Yeah, and the reason why it's complicated is because of some of these other peripheral issues that you point to, whether it's the ADP report, whether it's the fact that you have other job search engines talking about emergence of some recovery. So how do you trust the data? The data is different. How do you look at an economy that's changing structurally? And then how do you understand whether it's inflationary, disinflationary when you have an oil price shock, but you also potentially have an AI shock, which also could potentially have a productivity shock? I mean, this is a moment of shocks that is leaving us all reeling.
Is your head spinning? I think most people's heads are spinning right now.
Literally, I lay down at night 2 nights ago.
Feeling dizzy.
And I closed my eyes and the entire room started spinning. Maybe that says more about me. I had not been drinking anything, but I just
want
to
let you know. Thanks for clarifying, Brad. Thanks for clarifying. People were asking questions.
Maybe I should have.
Equities.
Okay, yeah, this is feeding into the idea of what our thesis has been for this year. It's going to be volatile. It's going to be shocking. We're going to get numbers all over the place. But essentially, it's a year of opportunity and probably a year of downturns, at least for the first half. And crypto is going to be volatile. We predicted a sort of a bounce in the first couple of weeks of March, but then potentially a downturn in April and May, same in October. Now we're getting the jobs data to back up what our thesis has been for potentially a recession this year as well. But double that up with oil prices as well. It's going to be a year of volatility and opportunity. I am going to do something special. There's going to be new people that have never watched the show today, and they don't know about the newsletter, and they haven't seen an offer before, an offer like this before. And we don't do these offers very, very, very rare. We do these offers, and because I want to give back, we're doing a 50% offer on the newsletter. So 3 people are going to get it, and only 3 people. These go fast. Every single time we've done an offer like this, they go in a second. So if you do want to get the newsletter, get all those cheat sheets, see what I'm doing with my portfolio, get educated for this year and build up your portfolio this year and understand all these data releases, get the cheat sheets, the FOMC cheat sheets, the data cheat sheets, be ahead of these data releases when they happen, plus the training course, the charts, the app with your net worth tracker, everything like that. You can get it for 50% off, but 3 people only. So I'm going to put it in the chat in about 5 seconds time. Please be quick, get ready. There you go. The link is in the chat. Click on that. You get 50% off your first year. You can cancel it if you don't want to be charged for the next year, but you can get 50% off. 3 people only. That's live in the chat right now. There is a free plan as well, guys. So if you do want to go check out the free plan, it's definitely worth checking out the free plan as well. So let's go back to these markets. The markets are now down. The S&P 500 had its initial wick towards the downside. It got bought up because that's what happens when limit orders are set up. Now it's continuing its down direction. XRP now down as well on the day, down 0.9%. That had a massive drop towards the downside. We've got the Nasdaq down 0.73%, Bitcoin down 1%. Silver had a little spike towards the upside, and here we go. Oil, the story of the day, the story that's causing all the problems that no one expected. But we caught the double bottom at $55 a few weeks ago. I mean, what an amazing trade that was. Again, that was part of the chart of the day. I give you charts every single day in that newsletter. That's up 9% today, which is going to cause some of these inflationary shocks, not only because oil is every part of the world. It's in everything you create. It's in all the transport industries. Whether it's personal or planes or shipments or whatever. It's also LNG and gas and the byproducts from fertilizers. That's food price inflation. And again, inflation going up and jobs being jobs. Today, we just saw a shock on the jobs market, which is actually bringing unemployment up. If we've got inflation up and unemployment up, the Fed is stuck between a rock and a hard place. And that's that stagflation issue we could certainly start seeing in the market. So again, that link is in the live chat. 3 people can get it this morning, and again, they might already be sold out. I can give it a check. Let me have a quick look. Because it will shut off after 3 people sign up. Let me see. 50% off 3 people. Okay, we've got 2 left. And again, it might take a second to process, so there might be none left. But there is 2 left on the newsletter, so go and grab it. Martyn will be live in a second. Let me see. Oil is now actually trading back up. Let's go straight back to Bloomberg for some further analysis, then I'll give you my final thoughts.
This is the household survey. We see a change of 18,000 people added to the labor force. Hardly anything. We'd seen more than 1,000, a million, 100,000, sorry, the prior month who went away. The employment situation, the level change for employment was down 185,000 jobs, while the unemployment level was up 203,000 jobs, people who were unemployed. So there's your rise to 4.4%. But the interesting thing here is that the number of people who are unable to work comes off of the household side. So to the effect there was an impact, it's on the household survey of the number of people who were not working. Retail sales, we've got numbers for them now, and the big drop was in motor vehicles, 0.9%, 0.9%. That's largely probably because of weather. All the cars on the new car lots buried in snow. Not going to get a lot of people who are out to look. 2.9% drop in gasoline station sales. Remember back when gasoline prices were falling? That was during the month of January. Clothing store sales down 1.7%, sporting goods down 1.2%, and those are post-Christmas kind of numbers. General merchandise stores up 0.4%, and food up 0.2%. So a mixed picture, people buying staples, not going out and buying things that they don't really need. And the overall picture here is that the economy was slower in January in terms of retail sales as people consolidated, and then the labor market was hit in February, and the question is how much of it is, as Stephanie pointed out, the birth-death model, and which was revised, and how much of that is also weather. But it is not a pretty picture, and I think you've reached the right conclusion. Chris Waller will probably vote for a rate cut.
I think it's fair to say. Mike, thank you. We'll come back to you in just a moment. There are some excuses, some reasons for this weak number. The strikes in healthcare being 1, the weather being 2. Ultimately, though, there's a trend here. The labour market has been weak over the last 12 months. That's been a problem. It's why the Federal Reserve has been reducing interest rates. And more problematic now, you've got this move in energy. Because as we speak, we seem to be approaching new highs in the energy market. Brent crude at 89.50 and WTI north of 86.
Yeah, the crude market's not responding to the demand side right now. It's not a demand side issue. So if people feel constrained in any way to spend, it does not matter at all for crude prices, given the fact that that is a supply side shock driven by the fact that oil cannot get through the Strait of Hormuz and, frankly, is not being produced in a lot of locations in the Middle East. This is a huge issue, given the fact that this is a stagflationary mix. How much weakness there actually is in the labor market, a big question, but it's happening at a time of structural change, which adds the extra anxiety on top of it of, A, how to read this, and how much you want to see a hot labor market going into this transition period.
There's a better story to tell for the American economy coming into 26. We've had the rate cuts. We're about to get the tax refunds, and some big companies want to spend some big money. But moves like that in gas prices could undermine the whole thing. If you're getting a tax refund, you start to see the price of things that you pay for every single day starting to creep higher. You'll be a bit more conservative, a bit more cautious about how you interact with the economy. This
is the reason why I'm actually surprised that no one's talking about the disinflationary shock of oil prices going up. There always has been a debate between whether it is inflationary or disinflationary, and over a medium and longer term, it is disinflationary or deflationary because of demand destruction. That has not been priced into long into the yield curve. I'm wondering if it's going to start being reflected a little bit more after this.
So the opening bounce about 46 minutes away, and here's the setup. Session lows on equities, down by about 1% on the S&P 500. Yields were higher for a fifth consecutive session, now off the back of that downside surprise on payrolls, now slightly lower at the front end on 2s and the long end on 10s. 10s back to about 412. And in the commodity market, crude higher by more than 4% on Brent to 89, on WTI up by more than 6 to 86. Joining us now to extend the conversation, Jeffrey Rosenberg of Black.
There it is. Markets, as we've been saying, they're bearish. That's why I've been ready, and I'm still not even deploying all my cash. Can I miss it? Yes. Yes, I might miss it. But my point is I'm a bit more of a high-risk trader. I want to catch the bottoms. I don't just want to be all in. And right now, the S&P 500 is at its lows of its day, nearly down 1% on the markets. Someone asked, is this bullish or bearish for crypto? Look, they're all crypto's higher risk than the stock market. So if the S&P 500 is down, it's bad for crypto as well. They're all risk-on environments. Bitcoin's not a hedge. Bitcoin's not digital gold. Forget about that. We've been trying to debunk that for the longest time now. It doesn't mean crypto and the stock market have to move in tandem. Crypto normally moves first. That's why we had crypto go into a bear market first. And now we're starting to see the stock market go into a potential bear market as well. So Martyn is now live. So what we're going to do is we're going to move over to Martyn, who's going to be live. I'm waiting for his countdown to start. When Martyn's countdown starts, we will be going over to Martyn for his thoughts on all of this as well. Where are we on the S&P 500? Let's have a quick look. Yeah, 6,700. Let's go down to that 6,700 support, and then are we finally going to enter our parallel channel? There is one space left. If anyone wants to join the newsletter today, there is one space left. I'm putting the link in the live chat. It's 50% off, one space left, and you can get access to all my deep dives, analysis, portfolio challenge, one-on-one DMs, trading course, daily news, portfolio insights app. I don't know if I've said it twice, but there's so much, and at a time like this, it's great to check out. Look at this. The equity markets are continuing their sell-off. Here we go. Crypto's now catching up as well as the rest of the market. Gold up slightly on the day. Silver up slightly on the day. Here we go. Oil just broke $87 a barrel, heading up to 90,000. I'm happy with my poly market predictions. As I said, $55 was the bottom. We took a trade on oil. Confirmation. This is in the charts of the day every day. So you need to make sure you check out the chart of the day every day in the newsletter. Breakout of the trend line at 61. Breakout the secondary trend line at $70. Then the poly market. Predictions of we're going to hit $80. That was fulfilled yesterday. I got paid out on that. The next one is $90, and I've even got some for $100 as well, because the risk to reward was great a few days ago. And let's see if that continues. Again, oil going up is going to have an effect on inflation. Let me go over to the live chat, see a few comments before. Let me see if it's Martyn. Yeah, Martyn's countdown is on. So I'm going to send everyone to Martyn. He's got 6 minutes on the clock, so I'll send everyone in just a minute. So you go directly into Martyn. So stay where you are. Martyn's going to give you... Oh, yeah, here we go. Here we go. The crash is unfolding on the markets. Look at this. Now down over 1% on the S&P 500. Down over 1% on the S&P 500. Oil going through the roof. This is what we've been talking about. And this is why we've been waiting. Or why I've been waiting. And again, everyone's strategy is different. Do what's right for you. Finally got me my 2121 account, but it's different to UK I read about. At least I got more stocks from the US now. Oh, brilliant human being, Liz. I love to hear that. Good luck to you. Welcome to the depression. Nasdaq in a technical bear market broke 200 MA, S&P 500 almost there as well. 200 moving average. Let's have a quick look. It's a lot. 200 week is a lot lower, isn't it? Let me have a look. Why can't I see it on my chart? I have to look. Oh, yeah, it's much lower. Good job, Sensei. Thank you, Kurt. Okay, for the final call, one spot left for the newsletter. Go and check it out, 50% off. You can go and check out all the perks and benefits there. Let's go over to Martyn now, who is live for you guys, giving you his thoughts and opinions. Plus, the title is AI and Your Money, how investors are making and losing fortunes using AI. So if everyone can go there and just do me a favor, say Sensei sent me, so he knows that I sent you. And we can spam his chat. I'm giving you full authorization or full permission to allow you guys to spam. So you can go in there and just say, Sensei sent me, Sensei sent me. Again, don't be too bearish. The market's going to be volatile. We might be up by the end of the day. Don't start FOMOing and go, oh, we're going to go into a Great Depression and we need to sell everything. And the market's going to be volatile. It's going to punish both sides all along the way, even into a bear market. It's going to have big rallies. Everyone's going to get excited again and then buy in, and then it's going to go down and everyone's going to sell and panic. Guys, control your emotions. Just because we're down now, maybe by tomorrow we're back up, and it's going to be volatile. I'm not predicting tomorrow we're going to be down 50%. I'm predicting a bear market, potentially a recession. Again, I'm not pricing in for that yet. But I think that is a risk of this year. I'm just pricing in on opportunities this year, and I'm not pricing in sudden tomorrow we're going to crash 20%. Be careful, control your emotions. Volatility is going to be there. We can be up 20% on Bitcoin next week. It doesn't matter. It doesn't change my long-term thesis unless we have big technical breakouts, and I'll tell you about that. Until next time, take care of yourselves and each other. Go straight to Martyn. I'll give you the link. It's live in the chat. It's pinned above. And if you stay where you are, stay there 30 seconds, you automatically get taken to Martyn's stream. Take care of yourselves and each other.